the big risks beyond AI as tensions flare in the Middle East, and new questions emerge about the health of the U.S. consumer. The investment committee is standing by to help navigate through all of that. So joining me for the hour are Joe Terranova, Stephanie Link, Malcolm Ethridge, and Bryn Talkington. So let's get a quick check on the markets right now. Overall, predominantly a down day fractionally, so roughly 0.5% declines across the major indices. The Russell 2000 down about 0.25% on the day so far. If you talk about the way that things are developing right now, there has been this debate about whether or not this is a risk on, risk off, risk aversion type trade, or is this just one that's a rotation? And maybe that's where we'll start the conversation off today. Maybe with you, Joe. Is this in your mind? We've talked about it a lot over several weeks now. Is this a market that feels heavy to you, or one that just feels like it's cycling through and reallocating away from certain parts of the market into others?
Yeah, Dom, and great to have you here with us today. I think it's more rotational volatility than exit volatility, where everyone's looking for, the move to the sidelines and looking towards cash. With that said, though, the market does appear to be spinning and ultimately ending back up in the same place. I think where we are today is maybe a moment to kind of sit on your hands a little bit, assess the portfolio. If you don't have the exposure to energy, what are you waiting for? We've been talking about that now for the better part of the last 4 months. Get some exposure to energy. It's not just about the headlines that we see with Iran. It is the fact that energy is actually seeing the earnings growth and the delivering in that regard. So I think this environment that we're in is going to continue in the near term. There's a lot of conflicting signals, and it seems as though the story in 2026 is really about, underneath the surface, the elevated volatility relative to what we've been used to the last couple of years.
Stephanie, if there are that many mixed signals in the marketplace right now, it almost begs the question, is it the status quo going forward? Because the status quo has been a slow grind higher, not an exponential move or a parabolic move for the markets, maybe certain parts. But if there are that many conflicting moves happening and signs in the marketplace, do we just keep that slow, steady grind higher, or do you expect a churn for quite some time?
I think you're going to see a slow, steady grind higher, but I think the equal weighted S&P is going to outperform the S&P. And that's because of what Joe just talked about in terms of the broadening out. And your question, are we seeing a broadening out, or is there something that's something that gets me more nervous? And I'm not nervous. I mean, the economy is growing at 3.5%, 4%. The consumer is K-shaped. It's mixed. We'll talk about that later. But I still believe the consumer is in a relatively healthy position because the labor market continues to be pretty good. Inflation is coming down as well. And of course, the other part of the economy is AI, and it's not just AI. It's data center power grid. We've been talking about that ad nauseum. But that is a huge tailwind to this economy, and I just don't see that changing anytime soon. CapEx numbers are going higher, not lower, and I don't think they're going to go lower anytime soon as well. And then, of course, we have productivity, which has been a surprise to the upside at 4.9%, which is very good. Lower inflation, higher productivity is the definition of Goldilocks. And so to me, you just need software to stabilize and have some of these other parts of the market do better for the equal weight S&P to do better. And I think that that's really what's going to happen. That's the theme so far this year. I feel very confident about that. And I am overweight in energy, in industrials, in materials, even in discretionary. Financials have been disappointing, but I think there's your opportunity as we continue to broaden out. As we talk about a catch-up trade, Malcolm, there are other parts of the market that are getting a lot more attention these days, besides those Mag 7 names. I remember it was, weeks, months ago that Ed Yardeni had talked about this idea of the Magnificent Seven versus the Fantastic 493, the other 493. It's kind of playing out the way it is right now. But to Stephanie's point, what exactly gets an investor or trader to feel like there is a stabilization that's going to be in effect for some of those beaten down names, especially in software and AI?
I don't know that we're going to see it anytime soon. I think that to the point that these guys are making about the equal weight being the thing to carry the weight of the entire market right now for investors, I think we have to look a little bit further under the hood, because it does look like a duck kind of going smoothly across the pond, but you can't see those feet going aggressively underneath the water. And what I mean by that is there's this huge divergence right now between the best performers in the S&P and the worst performers. So the best performers right now are energy and materials, right? And then last year's best performers are now our worst performers, which is tech and financials. And I'm talking so far year to date in 2026. If that continues, that dispergence between those sectors is what's worrying to me as an investor, not necessarily just the equal weight index itself. Because what that means is, I've made this case before, but something has to go meaningfully wrong within tech for the rest of the 493 to catch up and take over that gigantic ownership stake that was 35% roughly of the cap-weighted index. It's now about 29%, so it is starting to come in. If that continues to go that way, that means something's gone meaningfully wrong for the AI trade and everything else that's carried us the last 3 years.
Bryn, meaningfully wrong is what's arguably happened to certain key stocks in this market overall. I wonder from your perspective, if it's meaningfully wrong for the market to have reacted the way that it has, despite the fact that many of these mega cap stocks that carry such weight in the markets have seen significant, notable drawdowns, yet we are still a handful of percentage points away from record highs in the overall market. Is there a worrisome sign that there is a meaningful decline that should be at least watched out for in this particular move?
I think a lot of us on the panel have been talking about for some time that we're going to continue to see dispersion within these tech names. And I mean, good Lord, you can see that with just like Google versus Microsoft. And so I think that dispersion is going to continue. I think what's ironic, I mean, we're big fans of RSP. We've owned it for 2 years. Glad to see it's doing a little bit of a catch-up trade. But when you actually look at earnings and margins, squarely, all of the earnings and margins still come from tech. But what's happening, as we all see, is the market does not like the CapEx spend. And until there's a clear line of sight of what each of these individual companies are actually solving for, I think these, especially like the Microsofts, the Amazons, are going to be under pressure, because as they continue to spend that CapEx, and if you just go first principles, what is Microsoft actually solving for? Are they trying to have us all use Copilot? Well, so far that's been, I think, kind of a failure. Same with Amazon. Alexa is still terrible. And those are just like basic things that the market needs to see with these companies. And so I think until the CapEx slows down, which doesn't seem like it's going to slow down, these individual names that we really don't know what the spend ultimately is for, I think will continue to be challenged. And then on top of that, software, I think there's been a ton of technical damage. So many of these names, Dom, are well under the 200-day. And, you know, the proper adage is nothing good happens under the 200-day moving average. And so I think it's going to be tough sledding for the next few quarters at least, especially in the software names.
You know, the earnings story, because we are still in the kind of thick of earnings season, we're winding things down at this point. But there have been fundamental reasons why people should remain somewhat constructive. The earnings season is shaped up actually pretty well. Maybe some of the stocks that have reported into this decent earnings season have seen sell-offs in their shares post-earnings report. Is that kind of damage something that should be worrisome? Do earnings actually matter? And I'm curious because HSBC put out a report, right? They had some commentary. The S&P 500 is headed for its 5th consecutive quarter of double-digit earnings per share growth, tracking 13%, well above preseason consensus of 8%. But the S&P remains range-bound, struggling to break above 7,000, as sentiment opposed to earnings is driving market movements. The sectors with the highest earnings growth and positive earnings revisions, like tech and financials, are lagging the overall market. You guys have made this point. I wonder then, is there a fundamental catalyst, Stephanie, in your mind, as an investor that looks at things like valuations and fundamentals? Is there a reason why you should be a little bit wary about what's happening with the price action now, given a stronger earnings season on a relative basis?
I think we have to keep it into perspective, Dom. Last year, the S&P 500 grew 18%. The year before that, it grew 24%. And the year before that, 23%. So headed into 2026, while things are really good in the economy and earnings are double expectations at 13% and have momentum to continue the strength, expectations are a lot higher. So you're certainly not going to get, I don't think, multiple expansion, but I do think you're going to continue to see earnings revisions higher. Now, the market may not pay for that today. Maybe they don't pay for it for the next 6 months, but eventually earnings matter. Stocks follow profits on the way up and on the way down. And right now they are being revised higher. I'm not sure they're going to get to Ed Yardeni 17% growth. However, I'm comfortable with about 10%. And by the way, I'm comfortable with the S&P 500 doing 8 to 10%. That would be better than the long-term average. That's really what we should probably expect this year, just given that we've had such a nice run over the last couple of years.